Let's quickly discuss a very small and important topic for AFM and FM. That is, you have to know one concept, that is beta equity. Beta equity is always higher than beta asset. Why? Because beta equity is a 2-risk beta and beta asset is a 1-risk beta. Beta equity has 2 risks, that is financial risk as well as business risk. Beta asset only measures the business risk. So basically, beta equity will always be higher than beta asset. Why? Because beta equity measures 2 risks. Beta asset just measures 1 risk. Another thing, if you come across a question where you find that beta asset is equal to beta equity, if examiner gives you this information, that beta equity is equal to beta asset, then logically, technically, your beta equity is itself a beta asset. Otherwise, we know that beta equity is a 2-risk beta, and logically 2-risk beta has to be higher than beta asset, which is 1-risk beta. If question says, let's say beta equity is equal to beta asset, then the technical interpretation is, in that case, logically your beta equity is itself a beta asset. Okay. Now, let me tell you one more thing. By using capital asset pricing model, we can calculate KE, we know that. But there are 4 possibilities, and each one of them actually depends on the beta equity. Number 1, if the beta equity is 0, then definitely KE is equal to RF. The interpretation is beta equity 0 means you have made an investment where you are not facing any risk. Then your KE is equal to RF. That is, it means you have made a risk-free investment, means you have invested in government bonds. So your KE will be equal to RF. Second, if your beta equity is, let's say, less than 1, if your beta equity is less than 1, it means your investment is less riskier than the market. In that case, your KE is going to be less than RM. If your beta equity is less than 1, it means you made an investment which is less riskier than the market. Then definitely your KE will be less than RM. Third, if beta equity is equal to 1, we say it's a benchmark beta. And in that case, the systematic risk of your investment is equal to the systematic risk of a stock index. And logically, the KE will be equal to RM. KE will be equal to RM, that is average return. RM is the average return on a stock exchange. And the fourth and the last, if beta equity is more than 1, if beta equity is more than 1, in that case, it means your investment is more riskier than the stock index, then KE will be higher than RM. So these are the 4 cases that in each case, what is going to be your KE from CAPM? It actually depends on beta equity. It means we can say that KE from CAPM actually relates to the systematic risk of investment. So thank you very much for watching this lecture. The last one thing, I just need your 30 seconds. If you people want to revise the entire FM within 10 hours, so my smart crash course is available. If you want to revise advanced financial management within 10 hours, my smart revision course is available. And to be very honest, these 10 hours can change everything. So don't forget, just you need to spend 10 hours to change everything. So thank you very much.